Good evening, folks, and a warm welcome to all of you today to this another edition of WealthWise with Edelweiss, our webinar series on personal finance with industry experts. Joining us today is Mr. Swarnabha Mukherjee, the principal analyst at Edelweiss Professional Investor Research, with an experience of 10 years in equity research and a specific focus in chemical sector, specialty chemicals that is. He's here with us to share his overview on the outlook on the Indian chemicals sector. Before we start, since we are working from home, request you to please note that there will be a time lag of about 10 to 15 seconds due to possible connectivity or network issues. We request you all, gentlemen and ladies, to please bear with us. Swarnab, over to you, mate. Thank you.
Thank you, Zohar, for the introduction, and good evening to all the participants to today's webinar. As the title suggests, we are going to take a bird's eye view of the chemical sector today and discuss our outlook on the various subsegments of this sector in these testing times. Now, when we say the chemical sector, what we are referring to is actually far from being a homogeneous sector. Being the building blocks of all the products that are manufactured in one way or the other, this sector is extremely diversified. So chemicals are used from building medicines to materials for automobile parts, materials for electronic components, materials for in home construction, and all these things. And because of which there are hundreds and thousands of products in this subsector, and because of which each and every company has a different product profile and needs to be analyzed differently. Now, additionally, each chemical has their own value chain from the raw material to application, and each chemical can be manufactured in multiple ways using multiple different raw materials and using different ways to prepare them. To face such diversity, in the face of such diversity, basically, classifying the products in various silos become difficult. But then the question arises, why do we need to classify? The main reason is to understand how a company is performing vis-a-vis peers and to understand how the trends are playing in various subsegments. So, in order to try and sift through the various subsegments in most common way it is done is to classify in terms of various underlying chemistries. For example, products can be classified as alkali chemicals. These are primarily caustic soda, soda ash kind of products, or inorganic chemicals. These are products which do not have carbon as their fundamental building blocks. So products like titanium dioxide, chlorine, sulfuric acids are such products. Incidentally, alkali chemicals are also kind of inorganic chemicals, but because they are produced in bulk, they are classified separately, and they have their own value chain for production and the kind of products that eventually come out of that value chain. Now, one of the larger sized product chains are organic chemicals. So these are products which have carbon as their basic building blocks. Common products would be methanol, ethanol, and benzene. And then additionally, there are several diversified products out of these, like polymers and amines, who are classified as petrochemical products. These are the products who use crude as the starting point, and then basically through distillation and various other processes, these products are produced. Apart from that, there are products like agrochemicals and pesticides, which are also classified as chemicals. Now, this is of course a diversified set, but another way to classify these products could be by their application. Because they're building blocks of almost every product that we use in our daily lives, they can be classified by the application. For example, as you see on the slide, the first one, API intermediates. So pharmaceutical industries manufacture the drug, which is a combination of one or more active pharmaceutical ingredients, and while they manufacture the eventual drug, the underlying chemicals are produced by the chemical companies. Hence, we could actually look at a set of chemicals as API intermediates and analyze them. Similarly, we can see applications in other industries like, say, agrochemical and their intermediates, or say products which are focused towards the automobile sector. Now, this sector particularly uses a variety of chemicals. For example, pigments for painting of the cars, plastics in the body parts and polymer additives that go into that, rubber chemicals which goes into manufacturing of the tire, soda ash which goes into manufacturing of glass for the cars. Similar examples can be found from textile industries or food industries. So in food industry, for example, there are flavors, fragrances, and other food additives. Home and personal care segment, a segment that is seeing a lot of demand in this current scenario, where a lot of focus has come on soaps, detergents, and hand sanitizers. To summarize broadly, what I'm trying to say is that bucketing the companies are quite a challenge in this industry. However, we have tried to do that with a mix and match of the two approaches that I have just highlighted. And in the next slide, we'll take a view of that along with key listed players that are there in the industry. So in this slide, for example, we have used both the approaches discussed in the earlier slide to classify companies into various sub-segments, which will help us to analyze the trends of those companies. For products which are manufactured in large volumes, for example, caustic soda or soda ash, where companies like say Grasim, DCM, Shriram, Tata Chemical, GICL, these companies operate. They have similar products and use similar raw materials, and hence analyzing them in these classifications are a little bit easier. This similar examples we can draw from segments like dyes and intermediates, pigments, flavors and fragrances, where there is to some extent similarity in the products that get used. On the other hand, there could be segments where there is a lot of diversity, and hence products are basically companies are classified on the chain of chemistry that they are used. An example would be the aromatics bucket that we see on the top left hand side of the slide. So aromatics are basically petrochemicals, and they are it's a huge product category, and there are multitudes of products, and you will see that the leading players in the industry like Aarti Industries, Atul, Vinati Organics, Deepak Nitrite, all these players operate partially in this bucket, and hence has been classified under this. So similar examples would be in the field of fluorine chemistry, where we see players like SRF, Navin Fluorine, and Gujarat Fluorochemicals there. Another way to eventually bucket would be by the application. So for example, if you see in the center of the slide, there is this category called rubber chemicals, where we have selected players who are in the value chain of manufacturing of tires. So companies like Mosin Limited, Oriental Carbon, Himadri, Specialty Chemicals, Philip Carbon Blacks, Aptotech, the players who are instrumental in this particular value chain. They have their demand scenario linked to the auto sector's performance, and hence, in order to understand how the companies can perform, some amount of analysis can be done putting them together. Now that we have done the basic groundwork of how to classify the chemicals, we'll try to. So now we will take a look at what is called the pyramid of chemicals to understand how chemical products within a particular chemistry or a particular product line can vary in terms of how they are applied and how their profitability of such products are determined. So within most chemical segments, there could be products which are either on the more commoditized side of things, or who have very niche applications. So in most cases, the profitability of the product will depend on how specialized the application of the chemical is. So this chemical pyramid in this slide basically shows the dynamics of this, the volume versus the profitability trend. Bulk chemicals, which are produced and used in high volume, generally have a lower margin profile compared to a specialty chemical, which is at the second level in this pyramid. They have specific application requirement for which the customer pays a higher price for their performance. This results eventually in a higher margin of the specialty chemicals. So as we will see in an upcoming slide, that as a company invests more and more into R&D and moves into the specialty side of the products more from the bulk chemical side to the specialty side, because of the higher margin of the specialty products, their profitability of the company increases. Now moving up to the next two higher two stages, these are basically industry specific or customer specific chemicals, which are much higher in profit margin, and volume requirements are relatively lower as compared to the earlier two. So these could be products which are going into intermediates of agrochemicals and pharmaceuticals. These products require considerable R&D, quite complex synthesis processes, and the product needs to be delivered at stringent quality levels because of use in medicine or in agrochemicals. Some players also go into contract manufacturing along with R&D support for their customers, and these customers generally are global innovators or domestic generic players. So these business segments are highly profitable and generally give very good visibility of revenue, because a lot of the products selling is done through contracts, and generally they are long term in nature. So now with this background on various types of chemicals and how we can differentiate between the various product types and use it to analyze a company, we will move to the next slide where we look at the parameters which we can which we can look into to analyze a company. So of course it's a no-brainer that the starting point would be products, and this is what the groundwork we are doing in the last three slides, where we try to understand what would be the various product categories and in which value chain would the product lie. A detailed understanding of product is a really critical requirement to analyze a chemical company. However, a broader understanding of the chemistry and the subsector is also beneficial. Now, along with the products, what goes hand in hand is raw materials. The realization from the products and the cost of purchasing the raw materials, the difference between the two basically results in the gross profit of the company, and the gross profit margin actually reflects the value add that the company is doing in the product. As a general rule of thumb, the more the value added products, the better the gross margins would be. And also what happens is, this is particularly true for products in more commodities segment, is that the product and the raw materials may see divergent demand supply scenarios which might impact the gross margin. Fortunately, in such cases, most companies operate in a cost plus model, which somehow bakes in the price of the raw material fluctuation into the final product prices. This ensures stability in the gross margin to some extent. Also, we also need to be conscious about what level of integration the company provides, which means that if the company is vertically integrated, it is manufacturing a lot of the raw materials in-house. This brings in stability from the price fluctuations of the raw materials, as well as improves the efficiency of the whole manufacturing process, resulting in better margins. Along with this, the third parameter that one needs to look at is the demand outlook and how it is going to pan out in future. For this, an understanding of the end user industry is very important, and the following customer subsegments are also very important. So for example, in the current pandemic scenario, if we believe that the demand of the pharma sector would be quite strong going forwards, it is kind of a no-brainer that looking for investable companies in the value chain of the pharma segment would be a good idea. Now the fourth parameter that we can look at is the product mix. As I mentioned earlier, higher share of specialty products in the product mix could determine better profit margins for the company. Now, because chemical prices are volatile, the revenue that a chemical company clocks may depend upon the volatility of the end product prices. So in order to understand whether the profitability is there despite a lower revenue number, we need to look at the unit economics. Unit economics imply the profitability level at a unit volume of the product, and generally we look at EBITDA per ton or similar measures to understand whether on a per ton basis or a per unit basis the profitability has improved or not. Now, since we are investing in a company, considering how it is going to perform in future, along with the view of the demand scenario, what we need to understand is whether the company would be able to capitalize on the trend. For this, we need to analyze the capacity expansions that the company has planned, uh, or any kind of R&D investments the company has planned for future. Uh, Along with this, we also need to analyze whether the company has sufficient cash flows to undertake the capex, and whether the company has a strong balance sheet. A strong balance sheet with a moderate to low debt profile will help the company to not only fund the projects from internal accrual, but if required, to also raise debt to fund their capacity expansions. So broadly, these are the parameters that we need to look at while analyzing the company. There are several other parameters that one can look at, but because of the paucity of time, we'll stick to all these set of parameters. Now let us move into the growth trends that we see in the industry at the current setting. So, as you see on the chart in the left, in the global scheme of things, the share of Indian specialty chemicals is quite small. Compared to China, which accounts for almost 40%, and Europe, which is around 20%, and North America, which is around 60% in market share, India's market share is under 3%. And this despite the production capacity of the Indian industry going up by 4 times between 2000 between in the 2000 and 2017. Um, so this kind of gives us a idea that how the overall global industry has had been growing as well. For the Indian industry, between FY11 and FY18, the sector was growing at a rate of around 6%, as we show in the chart on the right hand side top. The growth has been more or less in close to what the global growth has been, which has been at 5% at that point of time. However, the expectation is that over the next few years, the growth of the Indian chemical industry will be much faster. One study pegs it at 9% of annual cumulative growth rate till FY25, and the industry will reach around $300 billion. Uh, this growth would be considerably higher as compared to the global growth rate. Now, these expectations were, of course, developed prior to the current pandemic scenario, and this scenario might have delayed the growth path by a year probably because of the current uncertainty that is there. But we believe that chemicals being the building block of all the industries, sooner or later the industry will come back to its original growth momentum, and we will be able to reach this size more or less within the target time frame. Now, what would drive this growth? There are two main drivers. One would be the domestic consumptions. The domestic sector will be aided by not only the consumption in the country, but also from the fact that companies would like to source more products locally than from international suppliers, because of the disruptions that have happened over the last few years in the supply chain, particularly those from China. Additionally, there would be a contribution from exports, and this might be significant as most companies see demand in specialty chemicals growing. Uh, for example, in this particular slide, what we show is that specialty chemicals is already more than half of what India exports, and because of that, the underlying penetration of specialty chemicals in global customers for Indian chemical companies would be significantly higher than, say, for example, in commoditized chemicals. As you can see in the chart, the commoditized chemicals is contribute less than 50%, and China has a huge scale out there. Indian market share in the specialty chemicals market is around a fourth of that of China. So we are significantly better off than we are in the situation of commoditized chemicals. And we believe that India might uh, be in a good footing to take advantage of any kind of China shift that might happen in the specialty chemical space, because of the technical talent and the R&D capabilities available in India, the intellectual property rights that are there in India, which are stronger, and a lower cost labor base. And I think this will be of immense deliver immense potential to Indian specialty chemical manufacturing players and contract manufacturers to have more and more tie-up with global innovators as there is any shift happens from China. Now, as we see in the chart on the right, India has already developed some market share in the API intermediates, agrochemicals, dye and pigment segments in the specialty part in terms of exports. So each of these segments in their respective markets have around 4 to 6% market share, which is about half of what China has. And these top three segments are also the largest in terms of the specialty chemical exports market, which is reflected by the size of the bubble. Particularly, we would like to highlight the API intermediate segment, that is one of the largest segments, and it is expected to grow quite strongly over the next few years, around 6 to 7% growth rate. We believe that Indian specialty chemical manufacturers are very well positioned to take a share of this pie. Now, all this eventually indicate that there is a good growth potential for specialty chemical companies to grow, and also the domestic companies to take advantage of the import substitution trends that may arise over time. Now, last slide of my presentation, what I would like to highlight is the near-term outlook that we see in face of this COVID-19 scenarios. These are mostly near-term and might quickly change because of trends emerging. But at this point of time, what we believe is that the sectors which would be least impacted are pharma, agrochemicals, and hygiene and personal care segments. Because of their defensive nature, they would see limited impact on the demand side, particularly hygiene and personal care segment in certain products like soaps and hand sanitizers would see strong demand expansion, and that trend is already visible right now. On the pharma and agrochemical side, there might be some challenges from raw material sourcing in the short term because a lot used to be sourced from China. However, I think the industry will be able to tide over that. In segments like flavors and fragrances, food additives, the probability of impact on demand is on the lower side. However, some minor impact may happen as individuals reduce discretionary consumption in this area. Uh, Chemicals side, we believe that there could be some impact on the negative side due to linkages to the auto sector because glass is used in this. However, any turnaround in the auto sector, particularly higher demand of smaller vehicles in the aftermath of this normalization of the lockdown scenario, can offset this trend. Also, they can see some positive impact from higher demand of detergents, where these products also do. On the colorant side, which means dyes, paints and pigments, we also expect moderate impact, particularly from the fact that pigments have a focus on the auto sector. Similar situation for polymers and additives because of their end-use sectors, auto and aviation, and similar from rubber chemicals. However, all the sectors who are linked to auto might see a turnaround as auto sector demand resumes back in future.